China's housing market has been described as the world's single largest asset class with a capitalization of excess of $60 trillion. It'll come down to the outcome of what the support measures look like for this sector and whether or not they work.
It's been more than 15 years since the 2008 subprime meltdown that triggered the global financial crisis. And in a cruel twist of déjà vu, it could be real estate that again threatens the stability of the global economy. The residential ghost towers in China are creating a debt balloon for Chinese developers, while in the U.S., the working from home movement has seen office rents tank and commercial real estate lending begin to tighten. To discuss this and more, Nick Wilson, Director of Real Estate from Oxford Economics, joins me now. Nick, thank you very much for joining us today. Let's start with what's going on in China with these ghost towers. So there are about 90 million dwellings that are either still in construction or even on hold. So what's going on there?
Yeah, that's exactly right. We've all obviously seen a lot of the photos and images of ghost cities and very large-scale demolition projects, but really the problem is a bit wider than that. For the past 20 years, China home builders have been commencing on more development projects than they've been completed. And so the net situation about that is that now there's around about 10 billion square metres of supply currently in the supply pipeline. So that we estimate is somewhere around about 80 to 90 million new homes. And the compounding issue on top of that is that already in the existing markets within urban cities, the vacancy rates of housing is around about 15 to 20%. So already there's about 60 million unoccupied homes in Chinese cities. And then if we add this additional 90 million currently under construction, we're left with upwards of 150 million potentially unoccupied homes. And so that's enough housing for nearly 400 million people. The challenge is these 400 million people at the moment don't exist. And we're obviously in an environment now where the population in China is starting to decline. Now, there are, of course, some offsetting factors to all of this, the key ones being that urbanisation continues, and also the average household size in China is shrinking. So if you have fewer people per household, you tend to require more housing for a stable population. But on our estimates of city-based analysis, we expect the total household formation in China over the next decade will equate to around about 50 million. So that's demand for 50 million new homes. That leaves us with 100 million homes that are unaccounted for. China's housing market has been described as the world's single largest asset class with a capitalization of somewhere in excess of $60 trillion. And so really it'll come down to the outcome of what the support measures look like for this sector and whether or not they work.
And central to this issue is this debt balloon problem that just seems to be getting bigger and bigger. So we have at least, we hear about it in the news all the time, the Chinese developers with the biggest ones, Evergrande, having more than $300 billion in U.S. debt, and Country Garden $200 billion. So how does the government in China sort of avoid a sort of Lehman Brothers shutdown situation?
For these companies at least, they've sort of already had their own Lehman moment. And fair enough, it hasn't, permeated through the global financial system to this extent. But there's no doubt in my mind that some of these large names that we've spoken about probably will not exist in their current format at some point in the near future. If we look beyond some of the headlines, in aggregate, listed developers in Hong Kong and China have total liabilities of around about $4 trillion. That's around about a fourfold increase on their position just 10 years ago. Now, with regards to the policy support metrics that could provide some relief, obviously there are a number of policies that have been implemented to date. If we're thinking longer term, what probably needs to occur are some structural reforms with regards to how home buyers' large down payments are treated. And so you put down a large down payment, pay that to the developer. They've used that as general revenue to go and buy more land projects. What I think we need to start doing to protect some of the home buyers is to earmark that capital and make sure that is used against the development of that particular project. So that's probably something that needs to be looked at further down the track. But as for silver bullets to solve the challenge, I'm afraid there aren't any.
Now, let's shift gears to the U.S. So same asset class, we're still talking about real estate, totally different set of problems. So in the U.S., obviously, the sort of work from home situation is a bit more stickier than what we've seen in Asia Pacific here. And that is continuing to put pressure on the commercial real estate side, specifically on offices. And do you see that continuing?
Yeah, absolutely. I mean, I think there are a couple of key drivers here. I mean, more broadly for the entire commercial real estate sector, obviously this fast pace of policy rate hikes that we've seen over the past few years is putting a lot of pressure on the pricing side for commercial real estate. So what we're seeing is that the office sector now accounts for around about 40% of total distress across the commercial and multifamily markets in the US. And the consensus is, of course, is that is likely to continue to increase further this year. Now, there's also been a lot of credit facilities over the past 2 years that have been refinanced on short-term loans. And so while there is quite a large wall of refinancing coming due this year, there's quite a lot of refinancing also coming due from short-term loans where lenders rolled over existing landlords in order to provide them with some time to try and fix their troubled situations.
Short term being?
Well, 1 to 2 years. So this has occurred over the past, say, 2 years as the assets have moved into a more distressed state. That has allowed some of them to at least resolve the distressed situation, but it's also adding to some of the refinancing pile that is coming due this year. So
the issue with commercial real estate is, of course, as you mentioned, some of this refinancing, and also for the banks itself, how exposed they have become for those who hold real estate debt. And particularly in the U.S., where we're seeing more of this, is the regional banks, which are having the issues. What are the balance sheets of these banks looking like these days?
Yeah, it's a very good point to make in terms of differentiating banks by size and focus. I mean, there is a clear concentration of commercial real estate loans being held by smaller and mid-sized banks. A lot of banks are now seeing commercial real estate loans account for upwards of 35% or more of their total assets. And so that has raised some concerns from the regulators. One thing to make note of, though, is that not all of these loans are office loans, and not all office loans are distressed. There are, of course, some scenarios whereby this situation can deteriorate. Now, I've mentioned the wall of debt that could come due over the next year or two. One thing that has obviously been providing a glimmer of hope for commercial property investors this year has been the expectation of policy rate cuts. And so if there was a reversal in that expectation, I think obviously that in itself would deteriorate confidence in the office sector further. That would also put more assets into a position where they are probably underwater, and we'd probably see financial distress increase a little bit more.
Thank you, Nick. And now let's check in with our resident economist, Alex Holmes. Alex, let's dig deeper into the working from home issue. There are many companies demanding their workers to come back to the office. Could this be a saving grace for the commercial real estate sector in the U.S., at least?
Thanks, Pamela. Yeah, return to work mandates are beginning to ramp up again. There's been news stories of Tesla, Meta, and BlackRock all having demanded employees return to the office. But overall, the work from home trend has proved remarkably sticky. That's probably been helped by the low unemployment rate in the US. A tight labour market means employees are calling the shots. Many businesses still feel they have to offer flexible working arrangements to attract the best and brightest, or indeed attract any workers at all. The results of this haven't just manifested themselves in the US. Office vacancy rates are continuing to rise in many places across the world. It looks like there is going to continue to be a mismatch between supply and demand for office space in the US and other major capitals for a while yet. And just to zoom out and look at the wider effects of the work from home trend. Of course, it is most obvious in commercial real estate, but residential real estate is also affected, given shifting preferences for locations and commutes. US consumption patterns too. Geographically, spending on face-to-face services has shifted from urban to suburban areas. Sectorally, grocery and restaurant spending is relatively outperforming spending on clothing, for instance. There's even this theory that aggregate spending on consumer goods in the US has remained above its pre-pandemic trend precisely because workers have more money in their pocket from not spending on services related to office work. That has knock-on implications for the kind of economies that sell goods to the US, such as manufacturers here in Asia, and so on and so on. The fact that implications appear to be far and wide kind of makes sense intuitively. For many, work is 50% or more of our waking hours, so it stands to reason that a big shift in working patterns has profound effects on our economic behaviour. We're just still trying to work out what those effects are. Anyway, back to property, Pamela.
Thank you so much, Alex. So Nick, you used to work in hotels, and that's sort of where the interest in real estate first peaked. How did that sort of develop?
Actually, that was I was at university, and I took a gap year from university. So I did some traveling, and I ended up working in this hotel. This hotel was in a new sort of precinct. There was a marina, a bunch of shops, and a lot of development around there. And I actually had the most important job in the hotel, in that I was the barman. And so the developers actually quite liked the bar. And so I got to know them quite well and start talking to them about the process, about how these things work. So at the end of that gap year, I went back to university and I changed my major to study real estate and development. And that was where it all sort of started.
And what was it about that whole experience in hospitality that made you understand how real estate is underpinned by sort of the communities or some of the other aspects aside from just the asset itself?
Yeah, well, I think, what that might have done is actually open up the idea that real estate is a lot more than just here's a home. Or, you've obviously got commercial aspects, you've got lending aspects, there's development and construction. And so to me, it kind of opened up the idea that it's quite multifaceted. And I think I've taken that even from a researching perspective, in that, real estate is a bit of a microcosm of the broader world. And so, instead of just looking at trends of what's occurring in real estate markets, you need to be a little bit of an economist, a little bit of a financial analyst, a little bit of an equity analyst. And I think more and more importantly now, you need to be across all of the social trends like work from home, and more importantly as well, demographics.
ESG.
And ESG, of course. And so we can look at a very broad depth of data and insights in order, as a way for us to draw views as to what is likely to happen in the future.
If we look back at 2008 and the subprime situation, banks were holding a lot of toxic debt. How would you rate the risk from toxic debt in commercial real estate now?
I mean, obviously every cycle is different, but that doesn't mean we shouldn't compare them. Clearly what has occurred, since 2008 is some of the lending metrics have actually improved. And clearly capital adequacy rates have also had to increase as well. And I think in this cycle, there's quite a few differences from 2008. Obviously, 2008, we had a bit of an asset bubble, a financial market meltdown, policy rates got cut to zero, and unemployment spiked. And so just from that, we can see that the differences this time around are that interest rates have gone from low to high. Labour markets have actually been much stronger than expected. And so we are actually looking at this a little bit more akin to being like the savings and loan crisis of the 1980s. I think some of the similarities there include things like a high concentration of real estate loans held by small lenders, and obviously property price declines now are creating a little bit of distress. And so, there are differences by cycles. One thing I would say, though, is that really the office sector has been in the sort of ugly duckling since about the year 2000 or the onset of the pandemic. And so what that means is that right now, the amount of supply coming into the market is very limited. That's going to at least allow the office sector to catch its breath a little bit and see if vacancy rates can stabilise out. Because in terms of the amount of distress coming into the market, we think a lot of it is going to come down to operating fundamentals, things like rental growth, vacancy rates moving forward.
Yeah, absolutely. And just to finish, there are, of course, two very different risks on the two opposite spectrums that we discussed today. In your view, which one is more worrisome? Is it China or the U.S. situation?
It's a very ominous question, but I think both have potential to cause a little bit more distress. Certainly, in terms of how they both play out, it is hard to see which one is probably likely to in terms of probability of deteriorating, I would say which has the bigger capacity to cause distress. There's no doubt in my mind that the China housing market would cause far more distress than the US office sector. Obviously, real estate services, credit for developers, and mortgages. And so, there is quite a widespread impact if this does get out of control. I think there's also an effect potentially on global commodity and metal markets as well as heavy industry. So China consumes around about half the world's iron, nickel, cement, and aluminium. And so commodity exporters would be heavily affected, and raw commodity processors as well. And then, of course, there's the fiscal and budgetary impact of local governments. Obviously, lower land sales would mean lower government revenues, and that could lead to more distress within the local government financing vehicles as well. So for me, there are a lot of areas whereby the China housing market could create some quite significant problems.
And you think everyone in the US is going to go back into the office?
No, I don't. There's a very, heated debate at the moment about what to do with all of the excess stock. I think in our estimation, probably only upwards of 5, maybe maximum 10% of office space in a place like the US could even be converted feasibly. And so, the US still has reasonable growth in its labour markets. There is a new normal. I think it'll be a fairly flat market for some time with regards to rents and vacancy. But it will find its footing at some point. And there will obviously be a lot of stock converted to other uses as well.
Thank you very much for your insights today, Nick. A big thank you to our special guest, Nick Wilson, and our resident expert, Alex Holmes, both from Oxford Economics. Thank you both. And thanks for tuning in to episode 5 of I See Your Trade Season 4. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Thanks for joining us today, and see you next time.